Topic focuses on the importance of risk planning, budgeting, and monitoring within institutional portfolio management and enterprise risk management frameworks. Effective risk planning begins with identifying the organization's investment objectives, risk tolerance, regulatory requirements, and operational constraints. Risk budgets are then established to allocate acceptable levels of risk across portfolios, business units, or investment strategies. These budgets help ensure that overall portfolio risk remains aligned with strategic goals while preventing excessive concentration or leverage. The topic emphasizes that risk management should be integrated into the investment process rather than treated as a separate control function. Continuous planning and disciplined risk allocation improve portfolio resilience, capital efficiency, and long-term investment performance. The topic further explains that risk budgeting requires balancing expected returns against risk exposures using quantitative and qualitative measures. Managers allocate risk capital based on the expected contribution of each portfolio or strategy to overall firm performance and risk objectives. Diversification plays a critical role because topic exposures across asset classes, sectors, and factors reduces vulnerability to adverse market events. Monitoring these exposures allows managers to identify unintended concentrations or deviations from strategic allocations. Risk budgeting frameworks also facilitate accountability by clearly defining risk limits for portfolio managers and business units. This structured approach enables firms to manage portfolio volatility more effectively while maintaining flexibility to respond to changing market conditions and economic environments. An important theme is the continuous monitoring of portfolio risks and performance. Financial markets evolve rapidly, causing changes in asset correlations, volatility, liquidity, and macroeconomic conditions that can significantly alter portfolio exposures. Managers therefore rely on regular reporting systems, scenario analysis, stress testing, and value-at-risk (VAR) models to evaluate portfolio vulnerabilities. Ongoing monitoring helps identify whether portfolios remain consistent with established risk budgets and investment mandates. Early detection of emerging risks allows managers to rebalance positions, implement hedging strategies, or reduce leverage before losses become severe. Effective risk monitoring therefore supports both proactive portfolio management and stronger organizational governance. Topic also examines the role of dedicated risk management units within financial institutions. These units are responsible for independently measuring, monitoring, and reporting risks across trading desks, portfolios, and business lines. Independent risk oversight is critical because it reduces conflicts of interest and ensures objective evaluation of portfolio exposures. Risk management teams establish risk policies, enforce limits, validate models, and communicate risk information to senior management and regulators. The topic emphasizes that strong governance structures improve institutional discipline and reduce the likelihood of excessive risk-taking. Effective coordination between portfolio managers and risk management units strengthens enterprise-wide risk control while supporting more informed investment decision-making. Liquidity considerations represent another major topic because liquidity risk can significantly affect both portfolio performance and risk management effectiveness. Illiquid assets may become difficult to trade during periods of market stress, forcing investors to sell positions at substantial discounts or preventing timely portfolio adjustments. Liquidity risk is particularly important for leveraged portfolios, hedge funds, and institutions with short-term funding obligations. Managers must therefore consider market depth, bid-ask spreads, redemption risks, and trading costs when constructing portfolios and assessing risk exposures. Stress testing liquidity scenarios helps institutions evaluate whether portfolios can withstand adverse market conditions without triggering forced asset sales, funding pressures, or significant capital losses. The topic concludes by discussing performance measurement as an essential component of risk management and portfolio evaluation. Performance measurement assesses whether returns were achieved efficiently relative to the risks undertaken. Managers commonly use risk-adjusted metrics such as the Sharpe ratio, information ratio, alpha, and tracking error to evaluate investment effectiveness. These measures help distinguish genuine manager skill from returns driven primarily by systematic market exposures. Accurate performance measurement also supports accountability, compensation decisions, and strategic portfolio reviews. Ultimately, integrating risk planning, budgeting, monitoring, liquidity management, and performance evaluation creates a comprehensive framework for managing institutional portfolios in increasingly complex and volatile financial markets while maintaining alignment with long-term investment and organizational objectives.